Hey everyone, welcome to episode 5 of Portfolio Talks. It is May right now, which means a lot of you are recovering from the PTSD that is personal tax season. So, what we want to do for episode 5 is talk about taxes because most doctors don't have tax planning. They have tax reactivity or, oh my God, it's tax time. Far too often, April comes as a doom and gloom day in the calendar, and we don't want that to happen anymore. So this episode is going to be strictly talking about why most doctors don't have tax planning and they have tax filing instead. So if you can share, like, subscribe, it really helps us on the front of bumping us up in the world of podcasts. And besides that, let's jump into it. Episode 5, Portfolio Talks.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking round the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
Welcome everyone, Portfolio Talks, and this is episode 5, taxes. But don't worry, we're teaching about taxes. Don't just automatically turn off the recording and scream and go, la, 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 I can't hear nothing you're saying. It's the good side of taxes. We're going to help you get ahead of your taxes, get smarter with your taxes, and start planning for your taxes as opposed to reacting to your taxes. So first and foremost, it is May 11th. So Mother's Day just passed. Happy Mother's Day to those of you listening. I hope you enjoyed all the love and appreciation that you deserve. Got some good food, got some flowers. The weather in BC was very, very nice yesterday. So Tyson, what did you guys do for Mother's Day? How was your weekend?
It was good. I mean, we went for lunch. We did a Mother's Day lunch. We did on Saturday though, because less lineups.
They're cheaper. Smart man.
Man, it's more manageable. And I ate my fill. I got to say, I'm good at that part. We had Greek food and the food was great and the dessert was even better.
Love that. Love that. Yeah. I always try and do like all these holidays. I try to do like a day before, a day after, just to avoid like the craziness. And then just the jack up on prices is insane. Like you can't tell me that flowers are worth, 40x more on one day, but such a supply and demand. But it was nice. I feel like my whole personality has changed over the last couple of years. Like in 2020, my personality changed to a golfer, and that's all I did. I was golfing, got new golf clubs, new golf attire, all that kind of fun stuff. And in 2026, I've become a gardener and a landscaper. So that's pretty much all I've been doing. Tyson knows this because every time he calls me to chat about something, I'm in my garden watering my lawn or trying to get it up. And don't let anyone tell you that home ownership is just fun, because it is a lot of work when you got to redo some lawns. But that's what we had to do for Mother's Day too. We went to like a nursery. There was like this massive one in White Rock. I forgot what it's called. West Coast Gardens, I think it's called. It was infrastructure. It was insanely big. So went there and I realized how little I know about plants and all things plants. It was wild, very beautiful. Went to coffee shop, enjoyed the good weather, went down by the water, and then we ended up buying a bunch of planters. So instead of flowers, I got planters or hanging baskets, as they call
Hanging
them. I realized
baskets. Yeah.
I went asking for planters. They showed me something that I didn't want, and I was like, oh no, I want stuff that like can hang from the hooks at my house. They're like, oh, a hanging basket. Yeah, that's actually what I meant. Other side of the store, and then I bought 4 hanging baskets. So that is flowers. We do hanging baskets now, which is nice. So yeah, hope you all had an enjoyable Mother's Day, either enjoying for yourself or spending time with your moms and your spouses and all that kind of fun stuff. So, what's more fun than Mother's Day is talking about taxes. So let's jump into it. As always, we're going to go through our kind of main cadence here. So we're going to teach you about some taxes, talk about some problems, what problems we're trying to solve, go into the Mythbusters, then we'll teach you about some stuff in our learning segment, and then finish off with the prescription pad. And if you're wondering why I sound so nasally, I apologize. I am sick. So I'm trying to get over and recover. So if I sneeze in your face, apologies. If I sound congested, apologies, but you can listen to Tyson a little bit more this episode than me. So that's always a good thing. So let's jump into it. So most doctors don't have tax planning. They have tax filing. I got some stories that I've realized over this tax year and when I was meeting with clients. But Tyson, what have you seen? Is that a common occurrence that doctors have filing, not planning?
I think it is a common occurrence for a lot of professionals. And sometimes I don't even think it's the fault of the accountant. I think that both parties don't invest in the relationship and have conversations regarding what do they want to have happen, what could they do that's different, and what opportunities are available to them. And that's really where, when we do like our financial literacy classes and our webinars, and when we speak to like the graduating classes from either the ODs or the dentists or the physicians, it's building your financial planning team or your finance team. because you're going to have an accountant, you're going to have a lawyer, you need a planner, you need an investment guy, you need probably some insurance planning. So you need to have a team that's integrated. And I think that's what a lot of people lack. And so when we bring on new clients, we find out what's happening or what has not happened. And yeah, there's very varying levels of, you have some accountants that they just do filing. Their way of doing it is they do it the same for every client. And there's not a lot of thought process. It's more like each client gets a cookie cutter tax approach versus a strategic, personalized, tailored plan. So unfortunate, but that's what we see.
Yeah, yeah, and I would just agree with that. So my entire month of April and really May, I would say, like 90% of my meetings have been with new planning clients that have jumped on and onboarded with us, or some existing ones that had some material changes in their finances that, to Nice's point, weren't caught till later, and more or less they're all about they spent too much money. Home renos or like a wedding in the family or something. So they had a more expensive year than they usually do. So for the last, like, let's say 50 days, I've been just meeting with clients and talking to them about taxes. And I would strongly agree with Tyson's point that it's not a malicious behavior of the accountants or a thing that they're doing wrong. I think it's really just understanding the capacity limits that professionals have of what they can and can't do and provide. Accountants are really good at the tax filing. Hence why the name of this episode is it's oftentimes filing, planning, because more times than not, the planning function isn't there. They don't have the capacity for it. It's not in their realm of expertise. And that's what we see time and time again. And it's the same thing that, I just had a meeting with a client last week, 2 weeks ago, and they had exactly what I was saying, a huge expense this year that was different because their sibling got married. So they're pulling money. They went overseas to do wedding shopping and all this kind of stuff. So they're like, oh, my tax bill is huge. I didn't realize that, I wish I would have known about this before, or they were just upset. And I was like, well, you can't be upset about at your accountant for that, because the same thing as me coming to you as a dentist and me expecting you to be an orthodontist at the same time. Like, we're going to optometrist and expecting your optometrist to check your eyes, and then I want you to do laser eye surgery at the same time. You should just know that I needed that. Or a GP, and what do you mean you can't just put a pacemaker in for me real quick while I'm here? It's a capacity limit. So there is a lot of work that comes into filing, and there's a ton of work that goes into planning. Very rarely can you get them on both. We do not do tax filing. We are tax planning. And even if we could do filing, we wouldn't do it because it's a capacity thing. You can only do so much for so many people. So you oftentimes will have a combination of a couple different professionals that specialize and do really well in certain areas. So if you look at it in your own field, you can understand it. So taking the same lens and looking at it in the accounting space will help provide you a lot of clarity as well. And one of the clients that we onboarded just said that. She's like, okay, well, now I have a really good understanding of the role of a financial planner, which is really just to handle and be like the CFO of the financial picture. I was like, that's exactly right. Far too often it is, once a couple bad things happen, and a lot of people are like, oh, okay, I see, now I need the financial planner. We always say, just like preventative health, you want to get ahead of your high blood pressure before you have high BP and you're on medication. Just like the same with your finances, you want to get ahead of it and have a financial planner as you start to build your career, which is, what Tyson just mentioned. We talk to all of our new grads, we talk to all of our association partnerships of get started early so you have a map to grow into and a skill to grow into, as opposed to getting slapped by the steering and then you're like, oh man, now I need a planner. So yeah, that's the not so fun part about taxes. But let's jump into the myth. So there is a myth out there that my accountant handles my tax strategy. We alluded to a little bit, but let's dive a little bit deeper into that. So accountants handling the tax strategy, is that a myth? Yes, no? Tyson, teach us.
Yeah. In general, it is a myth. And from what we've seen from a lot of different points of views is the accountant gathers all of the paperwork. They're going to build the tax filing and they're going to file your taxes for you. And they're going to do a wonderful job of that. But because you're not having conversations 6 months or 3 months after your last filing to plan for the next year, is nobody has an idea of how you should structure things, what you should expect, and what opportunities are there for you. And so it's kind of a relationship thing. It's an organic ball of dysfunction. It happens naturally, but because they're not taking steps, these things they build year over year over year. Now, we have come across some situations where we meet excellent CPA teams and they understand how to run a business. They talk to our clients about being business owners and what you should be thinking about. And so there are some good accountants out there, but I would say by and large, for the most part, people don't have planning conversations with their accountant, and so accountants don't have the conversation back, and there's no model for them to do this. Whereas when they come to a financial planning team, this is all we talk about. This is how we start the process. Where are you? What are you trying to do? What's going in? What's going out? Where are the opportunities? And then we go and we talk to the tax planning team. We might talk to the attorney. We might want to review the will, make sure it's current. And so we want to make sure that we're taking a wide scope of things. And I think that most CPA teams, they have hundreds and hundreds of clients. They don't have the bandwidth to drill down and spend 20, 30, 40 hours working with one incorporated professional client to map out their future.
Yeah, I agree. And I think, honestly, a lot of our clients come from the relationships that we have with accountants and CPAs that have that planning function. And sometimes the planning is knowing when to hand off. So they can have the preliminary conversations like, hey, it always starts with the reactive conversations. I would say for the most part, when people say my accountant handles my tax strategy, we usually know exactly where that's going. And we'll usually hear back from that client in a couple of years of, I have no idea what's going on. And it is not explained on the qualitative side. So accountants are really good on the quant side, the numbers and the reactive side of it. So at the end of the year, here's your tax bill. But most planning opportunities are already closed by then because if you're trying to do tax planning by April, only thing you're really trying to do is do a filing function. So you're trying to find deductions, find receipts, recategorize things. And you're trying to do it at the same time of like 4,000 other clients who all end up bringing their receipts and all that stuff at the same week, usually. So filing is a compliance function. It's not a wealth function. And you need both, but you can't mistake each for each other. So they're very, very different. So accountants, what we notice are really good on the quant side, but when it comes to the qualitative side of which of these plans make the most sense, that's really where they run into issues and problems. And the best accountants that we see that do the planning side, they know that we can solve this problem now, but it's cause for planning for next year. For example, a client that spent a lot of money over 1 year, chances are that's not the only time they're going to do that. So that triggers a planning conversation with the accountant. The accountant will have a preliminary conversation with you, which is tax planning, but they don't actually implement the strategy. They'll have a planner implement that strategy with you to find out in the marketplace what makes the most sense, how to actually solve that problem. But their planning will be, you have this problem right now, we're reactive to it. Let's get ahead of it because chances are, more times than not, law of probability is going to happen again. So let's plan for that. And then they do the handoff. So that's where we get a lot of our client relationships from accountants is when they have a problem, they react to it, solve the problem, and let's plan ahead so we don't run into the same issue again, which is really, really important. So there's actually a couple different things that we'll jump into now that we start to see as problems. So a lot of you may honestly have just had this issue in April or in previous years, or you're about to run these issues in the next couple of years. So what we wanted to do was debrief after tax season. Tyson and I sat there and we had conversations about all the meetings that we had with our new clients that were having tax issues. What are the four main things and a fifth will add on one that we want to talk about as a common occurrence? So jumping into our learning segment here, we're going to teach you about salary versus dividends. We're going to talk about installments. We're going to talk about income smoothing, and we're going to talk about DAFs and philanthropy. And then we're going to jump into our prescription pad after that. So switching over and let's start teaching. So salary versus dividends is a big thing that we always hear about. So every single year, I was going to talk about this later, but I'm going to talk about it now actually instead. This was the fifth one that was elective, but I would say that the vast majority of clients that were surprised by things happening in their tax window was because of a shareholder loan. Uses everybody all the time. Far too often, people think of a shareholder loan as, Tyson, I'm going to buy a house. I have my corporation. That's where my down payment is. So I'm going to take my down payment from my corporation. I'm going to borrow it for a couple of years. I'm going to pay it back over 2 years. So simple math. Let's say I took $200,000 from my corp. I will pay $100,000 this year in addition to whatever my expenses are, and then $100,000 in 2027, and then I'll be good to go. And that is a shareholder loan, which is true. The form of shareholder loan. The shareholder loan that people get confused about every single year, and I mean this every single year, because we have the same conversation every single year, is shareholder loans at tax time. What happens is, especially if you are a client who, let's say you're a doctor and you are not on payroll for yourself. So the way you use your money is anytime you're spending money, you're going to go into your TD online banking. You're going to take your money from your operating company account and switch it over to your personal side. You'll use that to spend it for a couple of weeks. Once you're running low, you're going to do the same thing over and over and over and over again. What's happening is you're drawing a shareholder loan throughout the year. So let's say it's 2025, you pulled 50K one month, 30K one month, 20K one month, 70K one month. That isn't payroll, that isn't salary, that is a shareholder loan. So your corporation is giving you the money and you haven't declared it as income yet. So you're drawing a shareholder loan throughout the year. When tax time comes around in April, you hear from your accountant of, Vishal, you have please send us your receipts, blah, blah, blah. You have an outstanding shareholder loan balance of $350,000. And right away, what happens? Clients call their planner and it's like, oh my God, like I have a $350,000 shareholder loan. We can log into our platform and see the spending. Like, yeah, that makes sense. Like you spent that money. And it's a total disconnect. So what I want you to think of, if you're the type of client that just moves money from one bank account to the other bank account and spends it, you're building a shareholder loan throughout the calendar year. And then when it comes tax time, you're going to decide how you're going to clear that shareholder loan on an annual basis. And that is where the salary versus dividend conversation comes from in a reactive sense. So let's say Vishal pulled $350,000 in 2025, not for down payment, but for general spending. I went on vacation. I bought Tyson that nice shirt he's wearing. I bought all the grass seed and all that kind of stuff. Has become my life for the last little bit. So $350,000 I've drawn on a shareholder loan. Come tax time, my accountant's like, okay, well, how do you want to clear this? I'm like, maybe I'll do I don't know, $300,000 of dividends and $50,000 of salary. Perfect. We'll file that. And now it's cleared. So going into next year, calendar year, tax year, I have zero shareholder loan remaining because I cleared it. And usually most of you will draw a shareholder loan every single year and you'll clear your shareholder loan every single year. It only really rolls over to multiple years if you're using it for like a down payment or something like that where you just drew too much or the massive you want to break it in a couple of years. But that is shareholder loans in a sense that you don't really know of shareholder loans. It's not only just using it for a down payment or a wedding or something like that. Oftentimes it's more common that you're using it throughout the year and then you're going to clear it on an annual basis. I wasn't going that later, but I figured it's more relevant now. Let's jump into it. So Tyson, anything to add to that before we jump into the actually salary versus dividend optimization?
No, I don't think so. I think you covered it great. Having an idea of what's going to happen. And if you don't have a strategy attached to your withdrawal, then you're not avoiding the problem. You're just deferring it and you have to solve it at some point. And if you don't tell your accountant about it up front, then they are reacting at tax time as well. And then you get these like really quick decision loops with no planning. And we have the same thing that we've been talking about.
Yeah, exactly. And I think that's another reminder of the capacity limits, right? So the reason why we can cash that with our clients and our clients rarely run into this issue unless something crazy happens is we have programs and platforms that can track their spending. So we have our team and we have support staff that will log in and be like, hey, Vishal, notice that you spend more than your usual halfway through the year. Let's book a call with your planner and blah, blah, blah. And then we'll have a conversation, get ahead of it and change some things. But for the most part, you can't blame that on your accountant when it comes to tax filing because how would they know? They only know when it comes to the tax time. And they're like, okay, well, now you have a huge shareholder loan. And, the explaining part is a little bit different. But, it's, again, a different function of filing versus planning. So that is salary versus dividends in a reactive sense, but let's talk about it on an optimization or a planning sense. So salary versus dividends for incorporated doctors, and I stipulate incorporated doctors because that's the only time it's really relevant. If you are a sole proprietor doc, like an early career, a physician, optometrist, dentist, you are a sole proprietor, so all your income is salary anyways. But once you incorporate, you could choose how you want to pay yourself. So for incorporated doctors, salary versus dividends, let's kind of go into it. What's the point of two of them? When should one be better than the other?
Yeah. Sometimes we come across accountants that have the philosophy of like dividends only. And in their mind, it's because you're going to be paying less tax. And it can be true in that you're going to save a little bit of money on the client's part of you can choose to not contribute to CPP or your dividends might even be eligible for a reduction. And so like you could theoretically pay less tax. There is something called CRA integration, which is, essentially CRA wants you to pay the same amount of tax whether you take salary or dividends or if you're working at a job. They want it to be fairly similar and they don't want to have a huge discrepancy. Otherwise, everybody would choose the route where there's little or no or less tax. When we start working with a client, a lot of things that we've done is really rebalance the equation to take a mix of salary and then dividends for like bonusing yourself. Part of the reason for doing that is 18% of your T4 salary that you would pay yourself builds RSP contribution room. So that's your retirement route, your exit. And like we've talked about in past episodes, when you take money from your corporation as a salary part, you're going to move that to the personal side. Instead of paying personal tax, you're going to get a little bit of a refund. It's going to cancel the tax out when you contribute that to your RRSPs. So it's kind of a tax deferred sweep to get it out of the corporation onto the personal side, build your retirement pipeline. The other thing that is going to do is it's going to build CPP contribution room. Now, because you are the business. You're the doctor, you're incorporated, and you're the earner. So you're the employee and the employer. You're paying both parts of the CPP contributions. This is where, some of the accountants get really hung up. They don't like it because you're paying a little over $8,000 a year, $4,000 for the employer, $4,000 for the employee. And that could increase over the years. And that's an expense that you incur. You get, like Vishal, like you always say, you get an indexed to inflation retirement vehicle that is there, and it's a paycheck that comes in every month. And if you don't want it, there's something that you can do with it, and we'll cover that in another segment. For dividends, they don't create RRSP room, but it's a nice way to bonus money out of your corporation to yourself in chunks, like you were talking about when you have these capital events, a wedding, buying a house, buying another business, maybe buying a car. You need to get cash out onto the personal side in a lump sum. Dividends is a great way to do that, and I account for that. I think the point of all of this, though, is to figure out a balance. And it's usually not all salary, and it's usually not all dividends. It's a blend of both, depending on what's happening now at this point in time, and then what we want to see have happen in 20 years from now, 30 years from now.
Yeah, really well said. And I think when it comes to, integration theory versus like real world examples and putting that into practice for you, it's not a one answer for everybody. What I would say is everybody should have some salary. So there should be some salary at some point in your finances. And Tyson nailed it. So we run into conversations with clients, accountants all the time. Like, oh, we prefer dividends because the client can outperform CPP if they just invest inside their corporation. True, but there's a lot more decision making that has to happen inside the corporation. So, for example, are they investing correctly, or are they going to run into the passive income traps? Are they actually buying something that's diversified correctly, or are they just taking that money and buying an individual stock, which may or may not perform the same as CPP? Do they even know what's the future value calculation that they need to get to in order to grow that money to surpass CPP and also have it indexed to inflation so they're not having a longevity risk? Because that is a reality for a lot of you on this call is, it is factual that higher earners have, more tools at their disposal to live a lot longer life expectancy because you have better supplements, better food, exercise, hobbies, all that kind of fun stuff. So in our space, longevity risk is one of the most important things that we talk about when our clients are building their retirement plan is if you could take care of one of the risks, which is longevity, deferring and building a robust government benefits platform that won't take you to the threshold area, then fantastic, let's do that. So those are all things to consider. So you should, for the most part, have some kind of salary in your plan. I can understand if there's like oh shit years where you're like, okay, I've done a shareholder loan, like we just talked about. I need to reduce my personal expenses, and I'm buying a house and I can't afford another large tax bill. So this year we're just going to do dividends and we'll go back to salary next year. Cool, sounds good. But for the most part, everyone on this call is going to have a window of their career that they're getting very close to that small business limit. And having salary will give you a huge deduction, which is otherwise almost impossible to get from anywhere else to have that size of a deduction. And it also opens all these other avenues for you, like RSP room and all that kind of fun stuff. The other thing I would say is depending what your career trajectory is, that can also predicate how you optimize how you pay yourself. So an example of that would be those of you on this call that have zero aspirations to own your own clinic that is sellable. Paying yourself a T4, a salary, is more important than your colleague who owns a clinic is going to sell it. Oversimplification would be that, let's say me and Tyson are both optometrists. So Tyson owns his own clinic or a couple clinics. I am a associate optometrist, so I'm just locuming at different clinics and I'm working at Tyson's base. So when we are getting ready to retire, we're going to have two different pathways to retirement. Tyson will be able to sell the shares of his company that holds his clinic to a different optometrist and use a lifetime capital gains exemption and some other planning mechanisms. And that is how he's going to get his money from his corporate side to his personal side of AMT problems and things like that. But for the most part, that is how he's going to get his money from his corp money onto the personal side. I don't have that option because I didn't have any desire to own a clinic, or I don't think a clinic will be that sellable. I'm concerned of the new pool of optometrists coming in, or I got to find someone that can buy me out. I don't know. Life's so expensive. I'd rather just easy breezy work, get my money and bounce. And that's fantastic too. My retirement will look very different. So I will have that lifetime capital gains exemption to move my money from the corp to the personal side. So a great freeish way to do that is throughout my career to open up RSP room so I can have that room there that I can swing my money from my corp side onto the personal side. Because as I say every single time I get an opportunity to, all of you need to get your money from the corp onto the personal side at some point. Whether you're alive or whether you're dead, that money is coming over to the personal side. You save an astronomical amount of tax by doing it proactively throughout your years. And I'm a financial planner and I'm also brown. So I'm cheap. And if there's free solutions out there, I would always argue that you should take the free solutions as opposed to these elaborate, expensive solutions. So before people start selling you on IPPs or PPPs or ABCs or these trusts and all these crazy things, is if you pay yourself a salary, you'll open up RSP room. You can swing that money from the corporate side onto the personal side. Yes, you'll trigger your marginal tax rate by taking corp money personally, but then you can remove that marginal tax rate by putting it into your RSP. And if you do it strategically with some other planning tools, you get to a point that when you come to retirement, you can be almost ready to close your corp by having most of that money on the personal side by paying off your debt, by filling up your registered accounts, by doing other stuff. You can be in a spot where you're not stuck having a redundant corporation. And this is the conversation we have with a lot of clients, accountants, is the accountants like, oh, well, they can build up a large invested portfolio by just, paying dividends, leaving the money in the corp and investing inside the corp. Like, yeah, true. Like no one's saying that's not true, but to what end? Like understanding from the planning standpoint that at some point this client does need this money on the personal side. Like for them to retire, they need to draw this on the personal side. So your corporation is really just a unlimited RSP, but you also have to pay annual fees to your accountant to keep it up. You also have to pay annual minute books. You also have to pay annual filing fees. It's a lot more expensive than a free RSP that's just sitting there on the personal side. So if you can solve both problems, one of them being free, one of them costing you a ton of money to just because you plan poorly and that you have all this money sitting in your corporation and you're retired and it's just sitting there because you don't want to pay a huge dividend to pull that money on the personal side, that doesn't really make much sense. Hopefully it gives you a bit of a framework of what makes the most sense for you. Generally through your career, you'll have years that you do salary, you'll have years that you do dividends, you have many years that you do both, and the balances will change throughout the year. And I'm not going to lie and pretend that you're going to listen to this podcast and change your ways. Most of you will be reactive where you're going to draw a shareholder loan. And then when it comes time to wrap that up at the end of the year, you're going to be deciding with your accountant and your planner, how much should we do salary? How much should we do dividends? But more or less, hopefully that points in the right direction. All right, moving on to installments. So CRA installments, what are these and where do they come from?
Yeah, CRA is not a big fan of waiting to get paid. And so they like to do quarterly installments. And so on the corporate side, essentially what they're saying is we know you're going to make about X amount of money. We want you to pay this amount of tax on a quarterly basis so that you're not running a debit balance with CRA. It's not a good position to be in. You don't really want that. And so for corporate incorporated professionals, you have to do that. There's not a lot of ways around it. For some of my seniors, and we're doing retirement planning and CRA request quarterly payments. On the personal side, I kind of say, why don't we just wait until you file your taxes? You might pay dramatically less tax than you would in installments, or you might even get a refund in some cases. But we don't get that choice when we're dealing with incorporated professionals. The incorporation is a business entity. They are required to pay tax. You don't want to be offside in your corporation with CRA. It's just a mess. And then you got to pay a whole bunch of fees to your accountant to make the mess go away. So quarterly installments are just what they ask you to pay for what your company should be generating in revenue and the tax that should be going to CRA.
Yeah, so I agree. I think when it comes to installments, they are annoying, but also fantastic at the same time because it sucks to have a lump sum at the end of the year. You're not really knowing you have all this working capital that could be working capital, but it's stuck sitting in a side account because you just don't know how much you're supposed to pay in your taxes. So installments, once you have a good tax year, so pretty much everyone on this call after your first year or second year probably because you're going to use your tuition tax credits and all that kind of stuff. So really when it comes to your second year, you're going to have to start paying installments. And as long as you have a optimized plan, you will have a floor of what your income should be, and you can make those installments. A good footnote for you to do is talk to your planner. Based on the plan that we have, we can give you a general tax rate of how much you should hold back. So if you have those capital events that Tyson talked about earlier, and you need to pull dividends onto the personal side, we can tell you how much you need to remit to the CRA automatically. So if you're going to pull, I don't know, $20,000 in dividends, pay like 5,000 into your CRA account, and that we're not stressing about it through the end of the year. You're just drawing dividends, and then at the end of the year, you're surprised. Oh my god, I have this huge tax bill. It's because you drew those dividends. So that's a good strategy or behavior to get into is just make those installments right off the bat because it'll also make you second guess pulling those large dividends for random things. Hopefully that will help. And at the end of the day, if you actually end up spending a little bit less, it is nice to get a refund and you can implement that capital into your financial plan in other ways. So installments, that's what it is. Surprises come, but you can get ahead of it with installments and smooth out your situation there. Speaking about smoothing, this is a big one. So income smoothing is one of the best functions of your corporation. So oftentimes people ask us, Vishal, Tyson, what is the point of opening a corporation? Can I do all these like crazy strategies? Sure. But more importantly, the main function of it is to smooth out your income because a lot of you on this call, you're going to have years that you're just working a lot. So you're going to have years that you have start a family or you go on vacation. So your income will fluctuate throughout your career, which is normal. What isn't normal is having your tax bill also fluctuate throughout the years. Having a corporation will allow you to smooth out your tax bill because all of your income is earned inside your corporation. If you do good tax planning, you'll be very close to the small business limit unless you're a little bit over that. But again, like paying yourself salary, things like this can give you large deductions. But ideally, you pay the small business limit as much as possible. And then you decide how much you pull over onto the personal side. Tyson mentioned this before about tax integration. Everything will kind of check out, and we'll go a little bit deeper into that in a different episode. Income smoothing in relation to your corporation, Tyson, marginal tax rates, what is that? How does it destroy wealth? What is the benefit of smoothing out your income?
Yeah, I think like you were alluding to is sometimes people get really large capital events and they pull a lot of money out. And so in that year, you're either going to pay a lot on the personal side in terms of like T4 income, or on the corporate side, you're going to pay for the large dividend that you've taken out, or eventually the shareholder loan, right? However you work, those are like your choices that you have. And so income smoothing is having an idea or a forecast of like what you're going to need. And for instance, we've had people, they want to do a big draw and they're going to do a down payment on a house. Well, if the timing is right, and say your corporate year end is August 1st, well, we can take half of it in July and we could take the other half in August or September. And now you've straddled year end and you're taking the same amount of money, but you're taking it in two different tax years. It's smoothing the picture out a little bit. The other place where we see this done very, very well is with our female incorporated docs, where they build their war chest and then they go on mat leave, and you don't have to worry about coming back to work in 3 weeks or 6 weeks or whatever. Sometimes they do because they're needed, but you can continue to pay yourself a salary out of your corporation, and it's as if you're still working because you've built that payment inside your corp. And then you can continue to trickle the salary or the dividends out, and it really smooths your income, and you're not taking a drop and then a spike to recover to pay off your line of credit that you racked up, something like that. It really allows for smooth income planning. And that's essentially what we talk about, man. If we can do it in a couple of different tax years versus taking it all in one year, then you're not going to spike to the top. Marginal tax rate, which in BC is 53.5%. Doesn't mean all of your income is taxed there, but the income above about 265 is. And, that's a lot of money to be given away if you didn't have to, with some forethought, some forecasting, and some planning.
Yeah, and I'll share an example here. So Tyson talked about marginal tax rate, and just a reminder for those of you on the call, marginal tax rate isn't your entire tax rate of how much you pay. It is your next dollar tax rate is a good way to think about it. So your next dollar, if you're thinking about paying yourself a dividend, if you're thinking about having picking up an extra shift or throwing some extra billing into this quarter, that is going to be the tax rate on your next dollar because that's your top tax bracket. So I'll give two examples. So example one of let's say you earn $350,000 and you are unincorporated. So you just pay that entire bill on the personal side. or you just do a large payment on the personal side. So let's just say you're unincorporated and the benefit of corporation. So if you're a sole proprietor or the career physician, you earn $350,000. Your tax bill is $134,000 in change. So as Tyson mentioned, you're in your top tax rate in BC. So your marginal tax rate is 53.5%. So that is your next tax dollar. So if you picked up, I don't know, another shift, or you threw some more billing into the cycle, your next, $5,000, for example, would be in that tax bracket. So 350K in 1 year, you're looking at $134,000 in tax, which is gross. But let's say, for example, you don't have that. You have your corporation. So you earn a 350 inside your corp, but you're going to break it out over 2 years. So that same money over 2 calendar years is 47,563. So you're looking about, saving like 40-ish thousand dollars, 39 and change. And you can see that because your marginal tax rate is a lot lower. So more times than not, you don't need the 350 all in 1 year. You might need somewhere around here. And instead of earning all that money on the personal side and paying that huge tax bill, you can instead smooth that over, optimize it over several years. In your personal head, you'll still get that same 350 over 2 years. You'll have the same 350 on the personal side, less taxes, but you're going to actually retain a lot more. You're saving about $40,000 of taxes by just smoothing it out over 2 years. That's just some real world examples of throwing some numbers behind what Tyson's talking about, the benefit of smoothing out the income over a couple of years. Hopefully that clears up a little bit and gives an example of two numbers, marginal tax rate, why that's important right here, and then also the benefits of smooth out your tax over the same 2 years, because you'll save a lot more money on taxes doing it that way because you're keeping your marginal tax rate below. And this also is true for retirement deaccumulation planning as well. We want to be very mindful of your marginal tax rate with all sources of income. So moving on from income smoothing, I think what we'll do is we'll skip prescription pad because we had a ton of questions on the prescription pad, but a lot of them were related to shareholder loan, which we talked about. But maybe what we'll do, Tyson, we'll do a separate episode, a special episode just answering questions around tax time. And we'll drop that in the next week or so. In addition to our regular cadence, we'll drop a special episode just answering questions around tax time because of the time that came in. But I wanted to spend that prescription pad time going through the calculation and then also talking about shareholder loan earlier on. So instead, we'll skip prescription pad today, but we'll finish off on DAFs and philanthropy because that is a question that comes up when it comes to tax time of like, how does that fit? People hear about it, they don't really understand it. So luckily we have an expert in that space, which is Tyson. Tyson, why don't we wrap off on donor advised funds, philanthropy giving, and how that plans into the taxes?
Yeah. So a lot of people don't. A lot of people give and they donate to charity or church or their hospital, especially our docs. Very, very generous. And when we go to our hospital galas and we're involved in those foundations, we see a lot of support from the doctor community back to hospitals and to the infrastructure that's there. The challenge I think some of them come across is they don't have a plan on how to give and what that could look like and how it integrates to the rest of their planning. And this is a new area that's really, I would say within the last 5-10 years, become very, very popular to the upper middle class, the high income earners. Sometimes we call them Henrys, right? They're high earner, not rich yet. We hear accountants say sometimes, hey, your tax bill is going to be X amount. Why don't you give some money to charity and then you're going to lower your tax bill? But there's different levels and efficiencies to giving where when we start educating clients and educating the accountants, there's different ways to do it. So sometimes you can have a portfolio like we encourage. The retained earnings, it's in your corp, you're allowed to invest it, you're allowed to grow that over time. But what happens if you're a 40, 50, 60-year-old incorporated professional and you have pregnant capital gains in your portfolio? When you cash those out, it's going to throw everything out of whack. It's great because you made lots of money, but you're going to need a redemption strategy. One of the things you could do is you could donate from your wealth rather than donate from your cash flow. And you can actually move some of those securities over to a donor advised fund or a charity in kind. So you don't pay tax, your corp doesn't pay tax. When the charity redeems those, the charity doesn't pay tax. And now you have money either in your giving wallet in your donor advised fund or your church or your hospital has those donations on their side. They don't pay tax when they cash those out and the money goes to the cause that you want. Then what that does is that's going to give your corporation or your personal side a donation tax credit. And then you're able to redeem other shares tax-free, essentially, because they're going to cancel each other out. So it's a really good and unique giving strategy. And it's conversations that you want to start having with your team, September, October. We see a lot of year ends in November, right? So you want to start having those conversations in September and October so we could do those calculations, But on the personal side, you can open a donor advised fund as late as December 3rd. Don't do that. But you could open it up as late as December 31st, throw some cash in there, get your tax receipt for the calendar year, and apply that to your personal taxes in April. It's a fantastic way to do things. It really, really works well. So we had securities with lots of gains. I think that's probably one of the most efficient ways that you can give. The other way to give when we're talking with business owners is you're shutting down your company, you've paid off all of your business lines of credits, and you had life insurance that was to protect the loans that were inside the business. You no longer need it. Sometimes instead of canceling that, you can actually donate that life insurance and get a fair market value tax receipt for that. The charity will be able to use the cash value inside the policy if it's a permanent one. And then when you pass away, the charity gets the death benefit, but you or the corporation, wherever it was donated from, get the donation tax credit. And that allows you to pull other funds from your corporation or out of maybe your registered accounts and draw those items down to be more strategic, more tax efficient over the long term, rather than canceling something that you've paid for. You can put it to good use and get a tax receipt for it. So these are just some of the tools that we talked about. One more. I'll do one more, and then I promise I won't talk too much because I nerd on this stuff. When we're dealing with high income earners that have a couple $1 million in their RSPs or in their corp or in their non-registered accounts, and they say to us, Vishal, I'm really not counting on CPP or OAS. I don't even think I need it. Maybe that's why I'm going to do dividends. But when you get to retirement, you can actually take that CPP amount, and that's your pack to donate. You can send it right to your donor advised fund. It's going to go to a cause that is near and dear to you, your family, and your business. And then you could disperse from your giving wallet there. And you're going to get the donation tax credit from that. So every year you're going to build that up, and it's going to allow you to lower your tax profile on everything else that's happening in your surroundings. So it's called CPP philanthropy. I didn't come up with that name. Another great advisor did, but we do utilize the concept because it can make a lot of good. And I think that people would like to see good being done in their lifetime, not just knowing it could happen after they pass away. Why not see the goodness in your community, in your charity now?
Yeah, really well said. The only thing I'd add on to the last one, the CPP philanthropy, is sometimes it ends up being a net neutral position for your cash flow because you may have all different types of sources of income. I talked about that before. So it may push you over the threshold for old age security. But if you get rid of a portion of it, like start to donate some of your cash flow from your CPP, that'll bring you below the threshold. And then your actual in pocket income will be the exact same, but you have an added layer of philanthropy as well, which is fantastic. Lots of really cool ways. Again, planning is an ongoing conversation with lots of moving parts. One thing I always say is we live in a first world country, so we can have anything that we want, but we can't have everything that we want. So planning is a sequence of decision making and figuring out what levers you want to pull, what the best way to get to the end result is. Tax time is and should be just a day in the calendar that rolls by the same as July 30th. It shouldn't cause so much stress for you as long as you're planning appropriately. So hopefully this gives you a blueprint and some thoughts to provoke becoming a better tax planner as opposed to a tax filer. And of course, if you have any questions, feel free to join our Facebook group. I will link it in the bio and the show notes so you can ask your questions for the mailbag section or just reach out to us for any questions that you guys have. So besides that, episode 5, Portfolio Talks, like, share, subscribe. We're out and we'll see you guys next episode.